Welcome to FD Markets. This week has seen the start of quantitative easing by the European Central Bank. But what will this mean for European equities? Joining me to discuss this is Jake Robbins, Fund Manager with Premier Asset Management. Jake, we've already seen the start of quantitative easing, and it's already had quite an effect on the stock market. When it started in 2009, we saw a dramatic effect on the US market. Was that expected?
Well, of course, quantitative easing had never been tried before. So when the US started in 2009, it was a bit of an unknown quantity. The one thing we have learnt, though, over the 3 QE programs that the US has implemented and the subsequent 2 QE programs in Japan is it's an incredibly powerful monetary policy tool if the goal of your policy is to raise the value of financial assets. So not only have we seen bond yields fall and the value of bonds rise, but we've also seen a spillover effect on both the equity markets in the US and Japan, and of course also into the property markets as well.
Yes. Well, obviously the main effect was on US and Japan, but our next chart shows that when it moved to the very prospect of QE, which became clear in December, also had a dramatic effect on the market, and European funds have considerably outperformed since then. So even the prospect of QE has moved the market.
Yes, I think the difference in Europe was that QE was not a complete surprise. So when the US and Japan announced it, it took the markets by surprise and had an immediate, very strong impact on financial asset values. In Europe, it became very clear towards the end of 2014 that the economy was struggling. Deflation became a real problem for the ECB, and despite the Bundesbank's objections to quantitative easing, the market became very confident that the ECB would have to resort to it. Hence, it anticipated the announcement in January and the start of QE in March, as you can see by the performance to date.
Yes. But it wasn't just the prospect of QE, because we actually have had some good numbers coming through, or more encouraging numbers coming through on European growth, and of course the fall of the euro, which has helped matters.
Yes, absolutely. The fall in the euro obviously helps exporters, particularly in Germany. So the German economy has continued to do very, very well, having slowed somewhat in the second half of last year. And the fall in oil prices as well has also been a spur to Europe, which is a net importer of energy as well. So the combined effect of the euro, the oil price, and of course excess liquidity and incredibly low interest rates, it is having a positive impact on the economy.
Yes. It's partly also, is it not, a feeling that the US market may be overheating and concerns about the dollar, so which is one reason we've seen investors switching towards Europe.
Yes, I think that's right. I mean, ironically, the US is well into an economic recovery now, so much so that zero interest rates is no longer making sense, and the expectations are that rates will rise at some point this year. This is causing global funds to look for a new place to find a home, and given the quantitative easing program in Europe, and given the boost, the stimulus that it's receiving from the lower euro and the oil price, then we're beginning to attract international funds into the country. Yeah.
So do you see any threats to this, or do you think this will continue?
The one thing that is still unclear is whether quantitative easing genuinely boosts the real economy. The US is 5 or 6 years into a very, very slow recovery, really substandard relative to other economic cycles, and that's despite $4 trillion of quantitative easing. The one thing that the US did that was very positive was recapitalising their banking system very early on. In Europe, it's still very, very early to declare victory, I think, on the economic recovery. It's barely even started. And also there are deep structural issues still in the European economy. So in the short term, I think markets will continue to be very well supported. But I think as we go into the summer, markets will need to see some more improvement, particularly in the struggling economies like France, Italy, and some other places in the periphery.
Thanks. So it looks as though there is real momentum behind this move into European equities. But for this to be sustained, we'll have to see signs of entrenched recovery in the European economies.